Can you? There's indirect, which you learned in intro. And there is direct, which you're going to learn in 316. This is the one we're going to focus on, and not this one. So, cash flow statement, and this is one that most students find the trickiest out of all the statements. I suggest if, when we've gone through the example and all the notes, you're still confused, it could be learned in a different way in intro. All of us teach it different ways. You can use T accounts, do what I do, and then there's a whole bunch of variations in between. So I'll explain the whole process as if I was teaching it to you the first time. And you can either go with that, if you've completely another, or go back to intro and look at how it works. So this is totally about, can the firm generate cash and cash equivalent, and how it's changed over the year and why. So it basically takes the accrual method of accounting and turns it into cash-based accounting, and that's the only statement that does it. All the other ones are accrual. The date is a period of time, like the income statement, because you want to see how it changes over time. There's 3 sections: operating, investing, and financing. And operating, is the one that's different between these 2 methods. Everything else is the same. Okay, so cash is cash on hand and demand deposit. So when you put your money in the bank, it's a deposit. You can go in and say, I'd like to take that out. And they can know, you have to give us 14 days notice or whatever. Cash equivalents, and we've talked about this in the first half of the chapter, are short-term, highly liquid investments that are readily convertible to known amounts of cash and have an insignificant risk of change in value. They're made up of non-equity investments, so we said like bonds of another company, that are acquired with short maturities, generally less than 3 months. Cash and cash equivalents also includes temporary bank overdrafts as a reduction in the value. Direct or indirect method may be used to present operating activities. The direct is actually recommended by IFRS, but the indirect is the most used format in Canada. And that's probably because we do a lot of U.S. business and trade a lot of our companies on the U.S. stock exchanges. And so that's why we've probably stuck with the indirect. But the direct, as you will learn in 316, makes much more sense to investors. Okay, so let's go through each of the sections and look at the rules. So these little sections are kind of the rules. So you're looking at a change, you can go, oh, it's a current asset and it's going up, but you must do this. So hopefully you remember, in operating activities, and this is the indirect method again, you begin with net income and then add or subtract adjustments to reconcile net income to net cash provided by operating activities. So again, we're converting accrual into cash. Now, you can also start with comprehensive income and include gains and losses from OCI. But if you just begin with net income, and generally that's what we're going to be doing, OCI are not included. So we're going to focus on beginning with net income. Okay. So the operating activity section looks at current assets, current liabilities, and other non-cash items on the income statement. Okay, so if current assets go up, you subtract them from net income. If they go down, you add them to net income. And just one note with this, use net AR here. So AR minus AFDA. Missed the F. AFDA. There we go. Okay, example, if you want to understand, you can just memorize this, or you can kind of think of what's happening. So remember, you're converting income statement to cash. So let's say you had $100,000 in sales on the income statement. Okay? It's all cash. Well, if I tell you that AR went up by 10,000, did you get a full 100,000 of sales in cash if accounts receivable went up? Well, no, because 10,000 went to AR, so only 90,000 was cash. So AR went up, it's a current, goes up, you subtract it from net income. So you would take net income minus 10,000. Okay? So that's why if it goes up, you subtract it from net income. If it goes down, you add it to net income. Now with the liabilities, current liabilities, if they go up, you add it to net income. And if it goes down, you subtract from net income. So for that one, for the liabilities, current liabilities, let's say you paid, I don't know, 60,000 in cost of goods sold. Or it doesn't say paid, it says 60,000 in cost of goods sold. The question is, did you actually pay it? So if I tell you accounts payable went up by 5,000, what should we do to income? So did you actually pay 60,000 in cost of goods sold if accounts payable went? No. So you actually paid out less than that. Okay? So cost of goods sold for should be lowered because some is on account. Therefore, if current liabilities go up, which is happening here, we add to net income. So we would add 5,000. Because we actually didn't spend as much cash as it says, so that makes our net income go up to convert it to cash. Okay? So didn't spend as much in cash. So remember, we're trying to convert net income to cash. And this is a nice high net income, but actually 10,000 of it was put on account, so we actually only got 90,000. So net income is going to goes down. Over here, net income goes up. So you have to think about that sometimes. And hopefully it will make sense, because remember, you have done this already. You just might not remember. It was a long time ago. And I think cash flow is like your second last chapter or something. Now, the third thing we look at Non-cash items that decrease net income, like amortization expenses, amortization of bond discount, get added back to net income. Because when we record amortization or depreciation, what's the entry? Debit amortization expense. Credit what? Cash? What do we credit? Accumulated depreciation or amortization. And there's no vault. So again, we're trying to convert net income to cash. Right now it says, ooh, we took off a whole bunch of amortization expense. Well, that's not cash, so we kind of have to put it back. We took it off, have to put it back, so that's why we're adding it to net income. Same with losses. But there's also non-cash items that increase net income, like gains, amortization of bond premium, and I know in intro you guys didn't do a whole lot of bonds, but you're going to be doing this topic of cash flows with the direct method in 316, and you're going to go over all this kind of stuff again. And you will have already done bonds, because in 316 you have a whole chapter on long-term liabilities. Okay, so things that increase net income that aren't cash, like a gain, they get subtracted as they don't represent cash coming in. Now, there are differences between IFRS and ASPE for interest and dividends paid and interest and dividends received. So, on page 7, you can either have for interest or dividends paid. ASPE, operating if recognized in net income, financing if charged to retained earnings. And IFRS, you can put in either. Interest and dividends received, so coming in, operating, and for ASPE and IFRS is operating or investing. I try and keep them kind of the same. Well, first of all, you say if the question specifies, you do what they want you to do. So if question specifies, follow those rules. Otherwise, I just make it easier for myself and do interest paid goes in operating. Dividends paid in financing. And this is pretty much how Canada's done it. And so I'm not going to see much of a change flipping back because of FRS. Now, interest received in operating. And I would put dividends received in, you don't really see a lot of dividends received. Let's put them in operating. Okay, again, you can follow these rules and change it around. If the question specifies, then you just do what they say. If they say all their dividends paid are recorded in financing, then you know you're doing that no matter which one you got. Now, short-term loans do not belong in the operating activity section, but will be in the financing section, even though current liabilities. So you have to watch out for that. Then dividends payable is a current liability. But assess it with dividends in financing. Hope you can read that okay. Sorry about that. Okay, so I'm going to stop here and then start a new video with investing activities. So that was operating activities for indirect.